Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katsimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.
Hello, my name is Michael Stoller. What's the outlook for 2009? My apple, as Mr. Ficalora said, has a little worm potentially out of it. So this polished apple, I don't know where the world is going to be. But what I've done is I've brought together today 4 great real estate professionals, bankers, real estate professionals, economists, who are really going to give us their projection of what the gloomy outlook is for 2009. My guests include Joseph Ficalora, Chairman, CEO, and President of New York Community Bank; Stephen Ross, Chairman and CEO of the Related Companies; Michael Fascitelli, President of Vornado Realty Trust; and last but not least, from sunny California, or stormy California, Hassam Naji, Director of Marketing Research for Marcus & Millichap Investment Services, Real Estate Investment Services. So, last year, I think it was the end of November, the early December, I had Joe on the show, and I said to Joe, are we in a recession? And Joe, what did you say? This was, everybody looked at Joe and they said, what? What did you say?
I think I basically said that we were in a recession and that we likely were going to see it get much worse well before it would get better. And the reality is that all of the signs of a turning cycle were present. And the cycle that we were turning out of was the wealthiest and best cycle that we've had since, I guess, the Depression. 15 years of positive growth in wealth and certainly in all the things that are attached to that, and likely all needing to be adjusted or corrected. Unfortunately, we've also had significant adversity created by the acceleration and exaggeration of the present accounting rules. With those rules in place, banks like Citi and A.I.G. and Washington Mutual and all of the failures that occurred this year occurred because the accounting greatly accelerated the recognition of loss. All of that takes a tremendous amount of lending out of the market and creates significant pressure on the rest of the market to adjust down.
Did you think in last November, December, we were going to see it this tough?
No. I thought it would get a lot worse. I thought the economy would get much worse, but I didn't foresee AIG, Lehman Brothers, and others like that going out of business or filing for bankruptcy or getting rescued by the government, and then Citibank and other huge financial firms, Morgan Stanley, Goldman Sachs. Those firms all...
in an earlier life, you were at Goldman. Mm-hmm. I mean, Goldman and, Morgan Stanley could have both gone under. I mean, they were on the brink in
Merrill
September.
Lynch was close to going on the one weekend. If they had gone, I think Morgan was in the waiting room, and who knows where Goldman was, but they weren't far away. So the whole financial system was on the verge of collapse. I think that overhang is still with us today and going to prolong this recession we're in.
I mean, you're on a national scale, you're national, you're regional over here, you're national. How bad is our real estate economy today on a national scale, Steve?
Well, I think we felt it, first in New York because we're so conscious of the financial crisis that occurred first. But I think now you're having an economic crisis throughout the country. And I think everybody in the country is feeling it the way we are. I mean, you first of all started in the residential area, and now it's spilling over into the other sectors. And I don't think there's anywhere in the country you can go where you don't feel it. I mean, everybody is, concerned and every right to be.
What are you seeing?
Well, I think looking back, you have to kind of separate what would have been a normal, let's call it recession, normal economic cycle that I agree was upon us. The consumer had been on a frenzy, the housing market had been on a frenzy, and those needed to correct. But even in natural correction in that environment, going from a frenzy to a correction, wouldn't put us where we are today. We all of a sudden took an economic downturn and a consumer frenzy that needed to be corrected, and add on top of it a originally capital market problem that then escalated into a global financial crisis. So it's very hard to ever be able to separate what would have been a normal economic slowdown, even with housing as bad as it was, even with consumer as overstretched as they were, versus where we are today, which is exacerbated into a much more significant economic problem because of the financial crisis. When you shut down debt in all markets, when you shut down the commercial paper market, as we did in October, businesses are not able to function.
But wasn't the commercial market, the real estate debt market was poorly run? I mean, anything, something went into a securitized package. They didn't care if it worked. The rating agencies had no idea. They had these, I hate to say, the 24, 25-year-old analysts making decisions on this situation, even on the Fannie and Freddie. Did they have an idea what was going on? Somebody brokered it in over there, and if it fit into the box. How are we going to change this?
Well, changing it is complex, but the first thing we have to deal with is what is causing it to be so extreme, right, and the speed with which it's occurring. If you look at this cycle turn, it broke at the top. It didn't break at the bottom. The fundamental asset, although it's devaluing around the country, is not devaluing at a speed that would be relevant to the overall capitalization of the financial markets. If you look at 2007, everybody thought that the capitalization of banking, by example, was significantly greater than it was in the prior cycle. However, that capitalization disappeared because the accounting rules took what was structured debt, which represented a significant component of the balance sheet of the financial markets. Structured debt was marked. And as a result, all of that structured debt was marked to market at the same moment in time. And as a result of that mark, everything was devalued quarter by quarter by quarter. So the fundamental assets, the underlying loans, might sit in a portfolio at 92, 97, yet the structured debt might sit in the same portfolio, which is fundamentally the same asset, at 12 or 14. So that devaluation greatly undermined the capitalization of Citi, by example, and others. So the reality is, if we don't change the accounting rules, 09 will be worse by far than 08, because you don't have just fair market value accounting. You then wind up having impairment. And if impairment is allowed to take hold in 09, it will destroy the fundamental financials of the markets that we're in.
So, I mean, Steve, you built thousands of condominiums. Where is the market today? Where do you see the market in 2009?
Well, today the consumer has lost confidence. So he's not going to buy in this type of period where he has no confidence in our whole economic system at this point in time. And I think that's where really, everything was priced to perfection. And then once the consumer lost confidence, everything just fell apart that fast. And I think until you can restore confidence and people want to go out and buy and feel they're buying something for value, it's not going to be cheaper if they wait another week or 10 days, which is we're still in quicksand, as I like to think today. And until we can feel some type of bottom and the consumer can regain some confidence in the system, and hopefully, President Obama will bring that to us and give us the consistency what we're looking for, and the change that he's talked about, and I think that everybody's waiting for. Things will be pretty.
But there's no immediate panacea. January 20th comes around, things aren't going to turn around overnight. I mean, we spoke before, prior to the show, we were talking, I asked Mike, how much rents have gone down? How much have New York City office rents? You're in New York, you're in Washington?
I think rents have gone down at least 20% and heading down still further from here until we get some kind of bottom to this.
Those are office rents.
Office rents,
Okay.
yeah. I mean, residential rents, how have they gone down?
Nothing like that. But we weren't priced at the same point,
The peak.
20%.
Right.
The percentage-wise, we're not down.
And what about on a national coverage, or how much do you think condominiums have gone down in New York City and in the nation? I mean, you have condos in Florida, you have condos in
really,
Los Angeles and other markets.
Well, every market is really different. I mean, if you take Florida, there was a tremendous oversupply of condominiums, and I think in New York we didn't have that same oversupply. But I mean, prices really in real estate are really based on jobs, And today we're losing jobs, we're not gaining jobs. And in New York today, we didn't overbuild, but we certainly today with lesser jobs, you have lesser people in the market and not having confidence, so you don't see a lot of things trading. The sales offices are very quiet. And people are waiting for, looking for bargains, and they're waiting to see what's going to happen. But I think prices have fallen, and it really depends where it is. At the upper end of the market, I don't think prices have fallen as much as they have, if at all, than in the middle of the market and the lower end of the market. There's no mortgage money available. Today, that's the biggest concern. There's virtually no mortgage money available.
For residential?
For residential.
Joe, do you feel that's true?
We're different than the really big players. The really big guys that have taken massive losses are not lending because they've in fact been forced to downsize. So they're stepping away from whole lines of business, and they're lending less in even businesses that otherwise they would normally be in. So they're all downsizing because they don't have adequate capital. They don't have adequate capital because in fact they're charging off massive amounts of losses on their structured debt.
But I think what Steve is saying is that somebody who's buying a condominium is not able to get a mortgage.
Well, that's true too. But that's because there are lenders who normally would have lent on that are not in the market anymore.
But there's also a value
At the end of
question.
the day, they don't have the mortgage money.
I think this is the big question that I brought out before to the group. And I said, what is value? I mean, people would always say, this is the value. What is value? I mean, land, forget the Drake site. Land was selling in certain markets. People believed that they could go right where your Caledonia project, and somebody would sell an M-zone hotel site for $500 a foot last year. They were trying to sell all the entire central parking lot sites because it was all going to be great development sites. There's no more 421 tax abatements. There's no more construction lenders. So what's value today? How much has values dropped?
Well, before you can really quantify that, though, you got to go back to your question about the rents, because the underlying performance so far on an occupancy and rent basis across all property types has been okay on a national basis up through the third quarter. We had positive rent growth for office, positive rent growth for apartment and industrial, negative rents for retail, which is not surprising. That's going to change going forward. There is no pricing power for apartments, so the rent growth is slowing, but I would be surprised if nationally apartment rent growth turns negative in 2009. I think NOIs will probably turn negative because rents are probably around 2-3%. By the time you figure in inflation and increased cost of operation, it's probably flat to slightly negative. Office rents, on the other hand, are definitely headed in the negative direction because of concessions and the lack of tenant demand altogether. Retail is really the one that's showing the most weakness in terms of rents upon renewal, and for tenants, of course, that just cannot hang on. And
I mean, how big is your retail portfolio?
About 10, 12 billion. I think it's crazy to sit there and say that '09 the rents aren't going down. They're going down all over the place, and there'll be a correction, and prices are going down. If you look at the public companies, they've been, their stock prices are down 50 to 80%. And that's the public markets always lead the private markets. The private markets are lagging behind, and there's been a real vicious repricing of the assets. Think about it. We're going through one of the worst.
But one is repricing the assets. The other is the rents that you're getting.
No, the rents. The public companies are reporting and will continue to report relatively good earnings, but that's because rent is not. We have 10-year leases. The marginal rent is not the key. It's occupancy that really can kill you quickest. So retail is suffering from bankruptcies and occupancy first. But my point is that in a deleveraging environment, which we're in, values of highly dependent assets on leverage, like real estate, are going to go down. And debt spreads are the widest I've seen in a long time. So what is the cost required for equity? What's the return required for equity? So when you say what's the value, people are scared. They're scared because of the environment. They're scared about where the bottom is. They're scared about getting loans. So values have been killed in the public markets, and the private markets lag. And unless you've had to sell an asset or a bank repossessed it, there's very little trading going on.
But there's a difference between the value and the rent. And what's different this time, and the good news is, if there's any good news,
fundamentals are better.
The fundamentals are better. Usually, it was the overbuilding of real estate that led a recession and led the cycle down. Today, almost every sector was in equilibrium, except for in certain areas where residential condos were overbuilt. So you didn't have this massive overbuilding that was causing the massive rent decreases in the past. So you won't find this time the type of rent decreases, if you will. But what you will find is massive devaluing of the asset because of lack of leverage. And the fact is, when people want to buy things, they're going to have lower loan to values in their mortgages, and they're going to need more equity. So your cap rates will be rising, which will cause massive losses in the value of the assets.
That's what's happening. But
that's what's happening today.
See, the real estate lags the economy.
Totally lags the
economy. So the
economy.
real estate fundamentals have been good to now, not bad. But they're going to get worse in the next. They're
going to get worse.
They're not going to get killed because of overbuilding, but unless we have a
right, the overbuilding that happened in the '90s is not here. We don't have those buildings, the vacant buildings. We don't have the vacant apartment houses.
I don't think we've ever had a business cycle that we've gone into a recession where real estate has been as strong as it is today from the fundamental standpoint.
Do you feel that way, Joe?
Yeah, I do. In fact, I think that there is a silver lining here. The reality is that the people that have cash, or in fact have good, well-managed businesses, will be able to buy significantly better cash flows in the future years than they were able to buy in the last 5 or 10 years.
They'll be able to have cheaper multiples.
Exactly.
On cash flows.
And that will be beneficial to everybody that participates in that trade. The sellers will lose, the buyers will win.
Well, if you have to sell. And you just won't find as many transactions occurring because people will only sell if they have to sell, knowing.
What happens when those collateralized mortgage portfolios, the interest-only loans at 80, 90%, not that you have, not that you have, not that you lent on, not that some of your other clients, come due? 2010, the end of 2009, 2010, 2011, and the rents don't equal the numbers. We were talking before about the apartments in New York City that were over-leveraged, a number of these apartment complexes. How are these properties going to get refinanced? Joe Ficalora is not going to jeopardize the balance sheet of a $32 billion bank to make bad loans.
It's really simple. More equity. It's definitely.
So wait a second.
More equity.
We all know these people in this business. Are these people who've taken out on a deal $150 million between, I mean, some of them, Rivington they took out maybe 80 million. Delano, they took out about 150 million. Are they gonna throw the money back into these deals?
Probably not.
Probably the bank will take them though.
The bank will take them and reprice them, and and they're going to lose a lot of money.
More equity for that
because they made loans they shouldn't have made. I mean, they were betting on future rent increases to allow them to have greater debt service.
The late vintage transactions, 06, 07, and beyond, are going to have problems. The reality is they might even have cash flow distress even before the debt maturity comes to play. But the good news, if there is any in this, is that the worst of it isn't really going to hit us for at least 5 to 7 years, because the late vintage had IO periods of at least 5 to 10 years, and the maturities are on average are about 7 years out. The question is, will the economy be much better in 5 to 7 years? You would logically think that it would be.
We talk about the food classes, residential, office. We didn't really get to industrial because in this market there's not that much of it unless we go to New Jersey. What about hospitality? I know you own this one hotel that you love so much, okay? And Steve, you still own some hotels?
No, I sold all mine last year.
Okay, you sold yours last year. Don't you have 1% of that hotel?
Well,
okay, so
for tax reasons.
For tax reasons. So what do we see in the hospitality industry? What's your thoughts? I mean, I did a panel this morning with 10 prominent guys that you all know, and they said revenue is going to drop 40%. The month of November was the worst November they've seen since 2001.
Mm-hmm. You're going to see hotel properties are going to decline in cash flow the fastest because they got one-night leases, not 5-year leases, not 10-year leases. And there's a lot of cutbacks in corporate travel. There's cutbacks because people feeling poorer, not want to spend money. So in New York, we benefited by a very strong dollar, a European traveler. That's going to be less.
Or a weak dollar.
A weak dollar, right. And now the dollar is stronger, there's going to be less European travel here. And I think we're going to go through what typically happens.
So have you seen it at the Pennsylvania?
Yeah, you started seeing in September, the cliff started being hit for retail sales, and you started seeing hotels in November, and it's getting worse. And it's going to continue in 2009 to be, I think, a very tough hotel market. And hotel stocks reflect that.
Everybody that I talk to in the hospitality business is expecting it to get much worse than it got after 9/11.
What about mortgage REITs?
Which ones are left? They're all trading at option. I think the mortgage REIT industry, there's 3 companies trading at above $5. I think they've been wiped out. And they've been marked to market by the market, to Joe's point, and basically determined they have very little to no value. They have kind of warrant value right now.
Right.
Does that you agree with that?
Yeah, absolutely.
Just warrant value.
Yeah.
And I don't think they have a platform that can be sustained going forward. There's no way to raise capital. Their cost of capital is higher than they can lend at, even with spreads as high as they are. So they can't. You have
totally.
More.
I totally agree with you.
That's just
But what? So Vornado has been a mezz lender, a preferred equity lender, and I mentioned before Arcadia lent money on 72nd Street. Do you see the REITs and other people, the relateds, through some of your investment partners, or as I always joke, and I still believe that you should be raising your rates and maybe coming with it. Do you see the so-called hard money world, or more preferred equity and more mezz money being put out there as a good formula for you to make some money for your company?
Yeah, I mean, you can get the answer is yes. People will make money with new lending, but secondary paper is trading at 15 to 25% senior in the capital structure. So until there's no lending market right now, we've had the worst disruption, and you can't get loans, and credit spreads for AAA CMBS are 1,100 over. So the market is completely upside down. Until there's a normalcy back to lending, real estate's going to have issues, commercial real estate, because it's so dependent on the lending market. And yeah, you see very good returns, but I'm not sure that the returns we see now is worth the risk given the market. And the other reason people aren't lending right now is they don't want to lend into a declining value environment, because then what you thought was AAA, you thought was triple B, now is down a rating. Right. And it's not a rating agency thing. I'm talking about an actual...
No, but you were talking before, we were talking about this property on the west side, that you were thinking of providing preferred equity.
Yep.
What changed your mind?
I think the alternative we can invest in with less risk are much greater today than they were to do that deal.
Right. I mean, people can't assess risk today.
Yep.
So if you can't assess risk, you can't lend, or they don't lend, I should say.
So how could you lend $3.5 billion this year?
Well, we're lending on rent-controlled, rent-stabilized buildings, so they're not subject to market values. The good news for that is.
But you also lent on the Brill building.
Yeah, but most of our lending is rent-controlled, rent-stabilized. So rent-controlled, rent-stabilized buildings in the last cycle didn't lose any value.
Oh, right.
We haven't had a loss in 29 years now in our multifamily portfolio, 29 years. So the fact is that we're able to lend because we lend on a product that's not driven by the market as much as it's driven by the cash flow that is restricted.
But also, you're in this market, whereas other lenders aren't going to come in to
That's
lend on
right.
that
You're
kind of
also an
product.
expert.
That's right.
I mean,
You're
that's
also
the
an
whole
expert.
thing. You have a
You're-
niche that
that's
no
right.
one's going to really
Exactly.
You're an
right.
expert in
compete
what
with
you
you.
do.
Yeah.
That's right.
But would
It's a
you
great
lend, if you
niche.
lent to office or retail today, you take a very
Oh,
cautious
that's a
outlook.
very different story. You're right.
You're in a-
You're right.
Right?
You're right.
Outlook on cash flows, outlook on cap rates, outlook on
Right.
loan to value. So,
Right. But,
well, I
but
wouldn't
you're,
do it at all.
you're talking about the reality of this market is going to present a lot of risk and a lot of loss. And although we are somewhat isolated because of the unique character of our niche, it doesn't mean that it's going to be the market. The market's going to be affected by everything else that's in the market.
Oh, there's no question about it.
Yeah.
Speaking of that, everything else, it's very easy to focus on all the things that are negative right now, which there are plenty of. But you have to remember two things. We had the lowest job growth rate in the expansion. So while there was a lot of excess everywhere in the system, there was no excess in payrolls. Payrolls stayed extremely lean coming into it. Now, the next few months, job losses are going to be very, very high. 250,000 per month, I think, should not be surprising. But the theory being that if we didn't overhire and didn't have bloated payrolls, somewhere along the way, that should help minimize the downside. Plus, we haven't seen the effect of the various Fed actions. We haven't seen what kind of stimuli is yet to come, which I think is going to be significant.
administration,
It's not going to help things in '09 necessarily or make a quick turnaround, but there should be some mechanisms in place. If we're already in a recession, which we are, we have been for the year, that will register to become one of the longest recessions. The longest one was 5 negative quarters in 73, 75. We haven't had anything that long and that deep since.
So, in summation, I hope that my apple gets a little shiny for 2009, and I'm really happy that I was able to assemble this wonderful group today to provide their outlook and what's happening in the world. I'd like to thank Joe Ficalora, Stephen Ross, Mike Fascitelli, and Hissam Naji. Next week, we have some other real estate experts trying to give their perspective on the outlook. See you next week.
Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.